Okay, if everyone could take their seat, please. The Dragon Lady is calling us back into order. All right, I'm very excited about two things to tell you. One is we put on each table a copy of the governor's press release that was issued this morning about Secretary Strickler's announcement. So I know that was really low key, but it was very cutting edge. It literally just came to fruition. So they issued the press release this morning. There are copies on your table to pass around and read. And thank you again to the last panel. That was wonderful. I'm really excited about the coming panel as well, because this is really a follow-on to that Resilience Funding Forum that I mentioned earlier from last spring. It's the next building block in the chain. I would encourage you to go to our website and look at the videotape or the PowerPoint presentations, or both, from that forum. It's really helpful. And this is the next step. I'm happy to have the opportunity to introduce David Johnson again. He was with us last May. He is the Chief Executive Officer of Hamilton Advisors and the Senior Advisor now with Michael W. Lauder and Global Associates. He has extensive experience working with domestic and international weather-related crises. He's been a Senior Advisor to the American Red Cross Office of Disaster Cycle Services, very active in the American Bar Association, and a wonderful comrade and collaborator on these events. I very much appreciate his wisdom and his assistance, and it's my great pleasure to introduce him to you today. Thank you.
Are we on? Now we're on. Elizabeth, thank you for that generous, kind introduction. It's a pleasure to be back at William & Mary and to build on the last wonderful conference, and it's fun to see how it has all evolved and the interest there is in one of the compelling questions, which is how do we pay for this stuff, which has been talked about a little bit this morning. I'm sure it will be addressed throughout the day. Our panel is going to engage in a discussion about what are the banks doing? And I do a lot of work now with resiliency finance, and have been surprised, but we're going to deal with that today, that oftentimes bankers are not at the table when we're talking about this stuff. So we are going to address that today, what the banks are doing, not doing, the challenges they face are complex, multi-dimensional, and we've got an hour and we ain't gonna get through all that. But what we hope to do is create awareness, begin a conversation about this, and as George mentioned in the previous panel, to identify how different financing sources can connect, collaborate, share information, and how they all fit together. So I think as a growth out of this, we hope that this will be the beginning of the discussion and certainly not the end of it. So thank you. The approach of this panel, we're all sitting down, as you can see. Each of the panelists are going to speak for about 5 minutes. And then we hope to have a lot of conversation among panel members and a lot of questions from the audience based on last evening's conversations and conversations throughout the day. We know there are questions out there, so we want to be sure there's time for that. So our remarks may be a little shorter, but it's on purpose. So let me, if I may, introduce the panelists, and I will go probably in a proper protocol, but I'll go from my left to the right. To my immediate right is Jim Hansen. Jim is regional president of PNC Bank. PNC is one of the 10th largest banks in the country, a $410 billion bank I have the pleasure of working with Jim in North and South Carolina matters. He and I serve on a nonprofit board in Charleston, where I live. And Jim and PNC are really at the forefront of resiliency, banking, planning, and thinking. So we are lucky to have him. I would just point out that one of the things, funding things we're going to talk about, all of us, is an act called the Community Reinvestment Act, which was enacted in 1977. It still lives today. It's taken on some different dimensions, and PNC has been recognized as a leader in Community Reinvestment Act activities. To put all this in context, and it was full circle for me today, in my younger days, many years ago, I was in-house counsel for a major bank holding company, and the Community Reinvestment Act was enacted. And one of my jobs was to figure out what it meant and to give the bank some guidance on what to do, and it's come all the way full circle. So it's going to be fun for you to hear and for me to hear sort of where we've come since then. To Jim's right is Nathalia Artis. Nathalia is Director of Community Development for Atlantic Union Bank, a Virginia bank, and I think I'll tell you, it's the first statewide Virginia-based regional bank here in over 20 years.
Correct.
So we're glad to have her. There's some real expertise in Virginia. Natalia has a wonderful story to tell, and we're delighted that she could do this. To Natalia's right is Jeannie Milliken Bonds. Jeannie has become a good friend, and her perspective on the things we're talking about is going to be uniquely interesting. Until recently, Jeannie worked for the Federal Reserve out of Richmond, where she was responsible for a number of community resilience development initiatives, including a great deal of work on the Community Reinvestment Act. Jeannie recently started a new job where she is the professor of the Impact Investment and Sustainable Finance Practice at Keenan Flagler Business School at UNC in Chapel Hill. And she's leading a new initiative on Invest to Sustain for communities and businesses. So Jeannie's perspective, having been at the Fed for a long time, having a big perspective on what banks are doing, and now sort of shifting some of that knowledge and experience to new funding mechanisms, will be very interesting for all of you. So we've got a good panel with lots of experience doing good things. And with that, the speakers are going to give their 5 minutes, and then we'll open it up to questions. So Jim.
Perfect. Okay, well, thank you, and look forward to the conversation here today. I'm going to actually be a banker and attempt to do this with no PowerPoints, so this is going to be entertaining. But I thought last night and today I've had a couple people ask, and I think a question I'm learning a great deal here this morning and throughout the rest of the day, and look forward to it, and is, do the banks care? Why does this matter to you? And which was a fair question and kind of took me back a little. And so I thought my comments, I went to the lead, our CEO's letter in our CSR report we just released, and I'll read it verbatim about how we look at this and why this matters to us. So, environmental issues, including climate change, are impacting our business, our employees, our clients, and the communities in which we operate. Furthermore, as one of the nation's largest financial institutions, we understand the importance of balancing financial priorities with environmental issues. Being conscientious stewards of the environment not only supports a broader transition to a low-carbon economy, but also enables us to better compete and subsequently yield long-term financial benefits. For these reasons, among others, we are focused on reducing the environmental impact of our internal operations, lending to clean energy projects, managing environmental risk across our lending portfolios. In addition to reducing our carbon emissions and energy and water consumption, we've enhanced our sustainable finance governance, tracking. We've grown our responsible investing and assets under management. We've enhanced our environmental risk management due diligence. And we recently joined Cirrus Company Network, which we expect will enhance our sustainability strategy and have committed to pursuing 100% renewable energy by 2025. So that's the opening letter of our CEO's letter in our CSR report. Very clear about what we see and what we're feeling, obviously, throughout all of our portfolios. And beyond that, we've set marks that we're measuring real time for our teams and that our clients and others can see, including we have a goal to reduce our carbon emission and energy consumption by 75% by 2035. We're the highest rated bank in the Barron's 100 most sustainable companies in 2019. We put out data on our sustainable finance and clients' ESG due diligence. So actually in the CSR report, you can see where we're doing further ESG due diligence. We make lending decisions and how we're measuring how often and what we're doing with that. We look at our energy, water, paper as touched on. Our square footage is LEED certified. We have 290 buildings that are LEED certified, started in 2002 down that path, and what that means when we look at water consumption. And then most recently, 2 weeks ago, we were the second bank in America to issue green bonds. We issued $650 million worth of green bonds. And we'll kind of touch briefly on that, but interesting to it is we opened them, and I told some folks that are asking, we had to open them to the market early, 8:15 a.m. Eastern, to catch the back end of the European market because of their appetite for green bonds. And so we can talk about the difference in and it'll touch very much in our comments where regulation in the U.S., which plays a big part of our business, where they are from a regulatory standpoint, and Jeannie has great perspective on that, her Fed view, to what's happening to our peer banks in Europe and other areas that are further along. And so those green bonds are set around our United Nations Sustainable Development Goals and renewable energy and energy efficiency and green buildings that we continue to invest in. So I think the big picture of my opening comments is, yes, it very much matters. And at the root of it matters is, look, our success as a company, and we balance our community and shareholders and everything else that large publicly traded companies do, but our success depends on the success of the communities in which we live and work each day. And those communities have to be in a place where they can be successful long term. And obviously, if they're dealing with flooding and climate issue and ongoing, and it's devaluing property, that has a long-term impact on wealth accumulation and other things that help drive the core of how our business operates. And so really appreciate the opportunity to be here today.
Thank you, Jim. Natalia.
Thank you. I guess I do have some slides here. Is it working? Yep.
There you are.
All right. So, well, good morning. Thank you for the introduction, David. It's my honor and pleasure to be included in this conversation and have the opportunity to share what Atlantic Union Bank is doing and plans to do regarding resiliency funding. Again, my name is Natalia Artes. I was born and raised in Brazil, so I already speak very fast and with an accent. So please make a notes and ask questions if you want clarifications on any statements after. Today is even more special because I have a 12-week-old at home, actually back at the hotel. So I drank like about 5 cups of coffee, so we're really powered up. I hope that you guys can follow it up. So we'll see how that goes. Atlantic Union Bank is headquartered in Richmond, Virginia, and expanded in coastal Virginia by merging with Zenith Bank, that in turn had merged with Bank of Hampton Roads, who in turn had merged with Shore Bank. I'm really telling you this because even though we're a new name to the region, we're not new to the region. Collectively, we have been part of the conversations regarding funding resiliency for a while. We have sat at the table with state resources, government officials, and nonprofit leaders. My role as Director of Community Development focuses on stewarding the bank's philanthropy, community development lending, and community investment goals under the Community Reinvestment Act, the CRA. So as David shared, it was enacted in 1977 with main goal to provide banking and services to all, inclusive of low to moderate income communities. The banks have to work with this regulation and are very serious on community engagement plans and ensuring that we meet the needs of the community. So as you can see on our footprint, we're very coastal Virginia, Maryland, and North Carolina. The bank regulators follow very specific definitions on what counts and constitutes as CRA-qualified activity. Unfortunately, climate resiliency funding is still not considered under the regulation as a community development activity. Nonetheless, many institutions, including ours, have started and plan to grow investment, partnerships, and funding products in this area. As a note, CRA is changing and is being revised this year, and hopefully we're going to see some new issuing of the regulatory agency OCC next year, and others may follow. We are strong advocates recommending actions to advance the discussion and purpose to include climate resiliency funding and investment as qualified activities. So this way we can provide even more support. At this time, resiliency efforts are for special situations, such as when FEMA designates a disaster area for special funding projects, or more commonly, an intersection and byproduct of current qualified activities. For example, the intersection happens on some of the core products we work with that target CRA response: construction and permanent loans for multifamily affordable housing units, and investments in low-income housing tax credits, LIHTCs, and affordable housing organizations. I personally took a deeper dive into resiliency conversation when I joined the bank and began acting as board member for statewide housing organizations, such as Housing Virginia and Virginia Supportive Housing. One of the first key items I learned was the high number of families and homes vulnerable to inland and coastal flooding from severe weather events. About 400,000 homes in Virginia are at risk from storm surge. That's about the number of homes in all Fairfax County. So here you have some numbers that I borrowed from the Housing Virginia information, is housingvirginia.org, and they have some great information on housing and resiliency. Under our housing programs, we have discussed how we can be proactive and help our customers plan regarding impact on property values, equity in rebuilding, and retrofit costs. We have just started discussions on how we can expand our support to customers and community on the topic of preparation, including anticipation and preparation of longer-term recovery. Climate change and housing vulnerability may lead to lengthy displacements, having a direct impact upon the health, education, employment, and well-being of households and children. These impacts are greater the longer the displacement. Our investment program has helped organizations that support housing planning, including minimizing rural isolation and health impacts from extreme precipitation events. Some examples of current activities that have shown that intersection between funding housing and funding climate resiliency are just in 2019, we were awarded $2 million in affordable housing program from the Federal Home Loan Bank of Atlanta. That's going to help to create or maintain 317 affordable housing units in Virginia and leverage over $50 million development dollars. The AHB, it helps to create equity in projects and organizations such as Newport News Redevelopment Housing Authority, so they can update their units to be more resilient. We're also actively funding organizations that run housing flood mitigation programs, from education to sharing information on programs that install higher piers, elevate utilities, and build flood vents. We plan to be more active in the resiliency funding through supporting affordable, quality, stable housing in three main areas. One, investing in organizations that help residents and communities prepare for recovery. Two, financing reconstitution of damaged residential units. And three, investing in targeted opportunity zone projects, in special ones that focus on more density to decrease cost of resiliency. Some see resilient housing as a challenge, but we see it as an opportunity. Funding climate resilient housing for us is funding the foundation for resilient communities. So thank you for your time, and I'm looking forward to hearing the discussion and your key question and answers. Thank you.
Thank you, Natalia. Jeannie?
All right, good morning. Happy to be here. Let me just start a little bit with why I left the Federal Reserve, because it's pertinent to this conversation. So we're in the Federal Reserve. The community development function is it's a little known function. How many of you have heard of that function in the Federal Reserve? Yeah, so less than 10 hands, and 2 of them are up here. So it's a tiny function. It exists in all 12 reserve banks. It also exists in the Board of Governors. And it was created because of the Community Reinvestment Act when it passed in the late 70s. One of the things the central bank figured out is, we have this piece of legislation, we have banks that have to do things, we have communities they need to do it with, and we have no one to connect them. And so the community development function was born in the Federal Reserve to really answer questions on both sides. Now, we have examiners in the Federal Reserve that examine the banks, pass judgment on what qualifies, what doesn't, but the community development's really that link between the people on the ground and the banks, training both sides and coming up with what the act was intended, which is to be innovative and flexible. And if you leave today and don't remember anything else about this panel, what I would say is just remember the CRA is relational. So no matter where you sit, what your role is, you have a relationship with a financial institution, and that's where you would start this conversation about CRA. So it passed in the late 70s, but it's really guided by a series of regulatory guidance that we provide. And when we start talking about disasters and resiliency, that really doesn't come into play in what we call the question and answers of the CRA until 2005. So in 2005, there was a lot of clarification about disaster recovery. And then in 2016, very recently, there's more guidance and examples about disaster recovery, and also something that we call a planning presumption clause, which is really not being used by the banks right now. So here is my first slide. So I left the Federal Reserve because I realized that out in the communities, there are all of these tools, debt, equity, different grants programs, different institutions that have resources that can be mixed and matched to help communities achieve their goals. The CRA is very focused on low and moderate income, but when you start talking about disaster recovery, it actually can be applied much more broadly to a community. But what I was concerned about was the ability to really sit down, roll up my sleeves, and help figure out how to make these investment connections in the community. And that's not something I could do at the Federal Reserve, so that's something I can do now at UNC. So there are relationships between a lot of these tools that you see. And I'll just point out a few, and I'll just say that I have a whole series of papers where you can read about some of the other ones. But for example, in the 50s, the SBA Congress passed something that created small business investment companies. How many of you are familiar with SBICs? Oh my gosh, okay, even fewer. All right, so there are SBICs that were created by Congress. They're administered and certified by the SBA. And then there's rural business investment companies, same process, USDA. They're much newer. But since the 50s, we've been investing in small businesses through these SBICs. A bank can invest in an SBIC, and they can receive CRA qualified credit for that investment. So SBICs are already out there working with small businesses. They're definitely entities that you would want at the table when you're talking about disaster and planning for disasters. So there's a lot of other tools on here that I would say that get involved with this, but over time with CRA, what we've tried to do with the banks is talk about a lot more broadly. Health, social determinants of health, all of those factors that go into the health of a community and individuals. How can you finance that? What are the relationships here? Health systems, they're investing in housing, affordable housing for low and moderate income communities. Opportunity funds, that's a new mechanism. How could that fit with low income housing tax credits and CRA? So this is really a mix and match of all the available tools, and it's something that should be considered in disaster recovery and planning. Now, I mentioned, so the CRA, besides being this huge set of regulations, it has some very specific definitions. And when I was at the Fed, I wanted to make it easy, so I created a video suite. So I would say you can go to richmondfed.org and just type in CRA videos, and we have a suite of videos that you can watch on your phone for about 5 minutes each that'll help you kind of think about some of the definitions. But basically, we have a definition of community development, and we have this disaster piece in there that says banks can go out after an area has been designated a disaster area, and they can receive qualified credit for their lending, investment, and service activities. So post-disaster, we have a lot of activities, and I'm sure as we go on, we'll give some examples. But what's not being used is this planning presumption clause, and that's where you come in, because there is this piece in there that says if a government agencies, federal, state, local, are working together in planning for resilience, planning ahead of disasters, banks can participate in that process and also receive qualified credit. And it could be lending, it could be investments, it could also be services. So from this piece of it, I would say you can also then start expanding into what businesses and institutions can do when they start thinking about social impact investments, which are that correlation between social benefit, environmental benefit, and financial benefit. And so that's where I'm going in the future, but I'll pause there and we'll have our discussion.
Thank you, Jeannie. That's very helpful. A couple of observations just based on what the panelists have said, which is, one, the great work that the banks are doing, and they do care. Two, as Jeannie just pointed out, sort of the multiple dimensional nature of financing possibilities and how they all fit together. But it takes work to figure them out. It takes work to see how they fit together, and it's not easy to do. Final observation is when Jeannie asked about how many of you know about things that she talked about, there weren't very many hands raised. So good news is we're going to talk about those and help folks understand them and at least raise the issues so there can be further exploration of that. And again, that's what we hope to accomplish today. So there'll be plenty of time for more discussion. We've got a few questions I'd like to ask the panelists, and again, just be sure that there is enough time before people stampede to lunch for you to ask your questions, because I know they are out there. Jim, we'll go from left to right again. The work that PNC is doing is impressive. How has climate change affected your business, how you do it, and how you interact with your customers?
Yeah, good point. Right, there's certain things we can do within our company, but then you have the other side. So one is, obviously for my region in particular, has the coast of North and South Carolina, and I've now become quite a regular in how to handle hurricanes and flooding and recovery of clients that takes years sometimes. And so what's changed is, we've put full crisis management teams in place, and we're trying to make decisions. I mean, you think about the last Dorian worked its way up a coastline, and for us, we're 6th, 7th largest bank in America. We bank about 7 million Americans, 55,000 employees. So we had to start figuring out release of information about 1 million affected clients running up that coastline, over 300 to 400 branches, buildings, major buildings, operations centers that we're now separating out into broader weather patterns where we put operations centers. So you can think about the ongoing effect of kind of all these changes and how we have to operate our business. And then you also then get to, we have CRA pieces, but you have individual clients, mortgage clients, where we may be servicing the mortgage, but it's Fannie and Freddie that actually hold the mortgage. You have to follow their rules on how you help them build their home or put a roof back on their home or whatever. It's not completely in our hands. And then there's corporate clients that are different, and we are already stress testing for that, and we see ahead of a storm coming, what corporate clients may be affected. We're trying to proactively help them. And then trying to get to small businesses is difficult. We do use SBICs and business development funds and others to try to help those recover. But it has definitely become, obviously, as many of us know, more often and more a core of kind of how we're thinking about the business. And then upfront and lending decisions too. We've started, we've taken certain NAICS codes, which is industry codes, with further eyes on them. We stress test our portfolio, which is not required by the Fed, but the bigger banks are starting to do that, I think, is stress test the portfolio and climate impact. And so all those, because again, I think the comment earlier on that developer in Boston, on that dirt, they have major risk. We have major risk also, and so we're going to do it whether it's, told to or not. But the recovery side is a whole different story and has challenges to it.
Jim and Natalia, so how does that affect how you view, review, and underwrite loans?
Well, do you want to go with
You want to tackle that one?
Yeah, so it's interesting that you say that, but we have to follow regulatory policy, and we also have our own internal credit policies. So we have to be prepared for and just doing that stress testing and reviewing potential loan loss to our portfolio. So we're very aware of certain regions that may be more prone to higher precipitation and flooding and more susceptible to weather events. And that is, of course, taken into account when we underwrite a deal. So like Jim said as well, it takes us longer to manage a deal that is a more susceptible area, so it costs us more money, so we sometimes won't even make money on those, especially if they're a small business and we're using some sort of government guarantee from the USDA or a project, because we have more reports that we have to follow, we have to visit that customer more often. So we're thinking on how we're gonna deal with that in the future, but right now we're just giving you more attention and preparing for it.
And, go ahead.
The only thing I just quickly add, for a broader view on funding and finance, there's 6,000 banks in America. So that means if Atlantic Union and PNC are thoughtful and do the due diligence, that it doesn't mean that one of the other 5,998 won't just do the loan blind and not do the due diligence, right? And we won't know how bad a decision that is until something bad happens or a recession happens or something, right? That's when usually it gets exposed in our industry. And then second is kind of anecdotal, but there's a belief, it's really hard to get a finger on it, but there's a belief that probably 50% of the financing in America since the crisis has occurred outside the regulated banking industry. So I also could tell you could come to me for a mortgage and I could be thoughtful about the piece of property, but if you don't like my answer, you could probably pick up your phone and pick one of 15 mortgage things that advertise through the Super Bowl and everything else that is running an algorithm in the central part of the U.S. that has no clue where that piece of property is other than it's going to run a floodplain cert afterwards, depending on when those maps were written, and that mortgage is done, right? It's not the local bricks and mortar banker that actually is living with the coastal community and thinking about it. And so then there's private equity lending into the space, and then there's direct loans, and you have all these things that are occurring, right? And so all of that plays into it. It's hard to, I think that's part of the question, it's hard to just say, well, why would the banks do this, or just stop them, and we'll stop this project from happening that should never happen. I can tell you projects that ended up on the 17th bank that finally gave the loan, and the project happened. And the first 16 knew it was a bad project. And so that's the difficult part of kind of getting your hands around the space.
And Jim, the interesting thing is the nature of the banking business has been changing quickly, regardless of climate change. The move from bricks and mortar, the bank competitors that are not banks, and it's compounded by climate change risk assessment. The dominoing of what happens if there's a mortgage crisis because of what could happen. So it's interesting to see how it all fits together. Jeannie, from your perspective from the Fed, are there, beyond the two banks that are talking, have you seen other innovative approaches from other banks that you saw, or best practices that you could talk about?
Yeah, so there's, going back to that capital stack, there's all types of other possibilities besides the entities that aren't as heavily regulated as our banks. Banks also invest in community development financial institutions. So have y'all heard of those? CDFIs? Oh my goodness. So I have classes and I need to sign everybody up.
Yeah.
So we have community development financial institutions. You have a huge one in Virginia. It's called Virginia Community Capital. They're certified by the U.S. Treasury. Banks capitalize them, and then they work in low-income communities as well. So there's lots of innovation in that space as well. And banks are being innovative within the regulatory environment that they're in, absolutely.
It's good to hear you say that, because I think there is a perception that, banks are stodgy and conservative and stuck in their ways and they don't get it.
Right.
But it's clear as we've dug into this that that's not the case.
Right.
Says the retired banker.
Yeah, if you're planning for resiliency, you want a banker in that planning. You want a bank to be there. I tell that to health departments if they're looking at health issues. no matter what it is, you want a banker to be on that team with you thinking
And
through it.
I think that point was made in the previous panel, that with all of the planning that goes on, an integral part of that upfront is financing. The broad spectrum of financing, what works, what does not work on a particular kind of project, and clearly the banks need to be part of that conversation.
Yeah, and it's not just for profit, if I may add. I
Please.
think it's just good business because you have the human capital that actually provide for our business and also the consumer base for our products who give us the revenue and profit. So I think we have more of an interest in that side as well.
Jeannie, one more question for you, and then let's be sure, there are a lot of hands sort of moving out there, so I want to be sure we have a chance to get to them. If you can do it, and it would be hard to do, but what is your sense about where federal regulation is heading?
I am so glad I don't have a disclaimer. I have to say no. So,
I wouldn't have asked you if you're still with the Fed.
yeah. So in terms of banking, I think there's probably a lot to come from all three banking regulators. So there's the Office of the Comptroller of the Currency and Treasury, there's the FDIC, and then there's the Fed with respect to banks' continuity plans, risk. And also, I think they're probably going to see more regulation or adjustment to their regulation with respect to that. CRA has been really flexible. So in addition to the disaster pieces, banks can invest in broadband. It's been categorized as an essential infrastructure. And they can also use it under the service test, not only to expand their services when bank branches close, but also to participate in digital equity for communities. And then another key area is workforce development. So, why am I bringing that up? After a storm, you want people to get back to work. You want the economy to recover. The CRA, there's provisions in there where banks can invest in workforce development programs. So there's some flexibility in existing regulations. And while we may see some tightening up around some of the other more riskier side, the CRA is still there as a flexible option.
Yeah, and I would just lean in on this one because, CRA is something for banks we are very aware of and live with, but just so you're broadly aware, so fintechs that aren't regulated in the banking industry, direct private equity lenders, credit unions are not CRA requirement. So they have no CRA requirement. And so, again, when you think about if you think about your community and what's lending into it, if, a Quicken Loans is doing the mortgage, they have no CRA requirement in your community. If I have a bank branch, and this is where some of the policies are starting to get rewritten to be more thoughtful about getting to kind of matching CRA with where lending is occurring, as everything has changed, in the last 10 years on this phone. And so if the basic is, if I have a bank branch in a county, I, as PNC, will have service loan investment requirements there. If I have an ATM that dispenses cash in the county, I don't. If I have an ATM in the county, and it has deposit-taking capabilities built into the ATM technology, I have to do lending service and investment in that county, right? So this is 1977 written with great intention, some flexible change that Jeannie and the Fed have been working on, but it's still written not thinking about how finance is occurring today in our communities. And so that's a huge one that is. So Powell was, on the Hill that yesterday, the first time a Fed chair was on 2 days straight since 2012, and for folks like us who read these things, so some of the conversation was on CRA reform and then what the OCC and FDIC are going to lean in and how they're going to try to come together. But that is a big potential change to help keep supporting communities that is occurring in federal regulation right now as we speak.
The other interesting part on that is sort of the recent pronouncements that have come out of the San Francisco Fed and the New York Fed recently at a conference that was in early November in San Francisco about, the risks that the banks are facing related to climate change and the things that those feds think need to be done and how to do it. What's your sense about that, Jenny?
Well, it's our central bank is years behind central banks in other countries that have been considering this, and it's a political issue. So for years at the Fed, I had to walk around talking about weather-related disaster recovery, because I needed to say weather-related instead of climate change, because if I was in North Carolina, I might get slapped down by somebody for saying climate change. So it's really wrapped up in the narrative and the phrasing. So the Fed is starting to study this more. You've got San Francisco, they've got wildfires. New York stepped in, Hurricane Maria, Puerto Rico's in their district. So we're just trying, in the Fed, it's just trying to get around that narrative of how do we phrase it and how do we talk about it. The community development function is a nice way to ease into that conversation.
Well, let me ask one more question and then open it to question. Natalia, your bank, with all the interesting work that's going on and that you're doing, what are the challenges, obstacles, and solutions that you most focus on?
Well, I think that the challenges come also from the regulators. There's a lot of conversation, a lot of talk. There's not a lot happening. And once they issue the articles, they're not really changing the regulatory policy. So there is no really strong support there as far as benefits, rewards for continuing the conversation or helping and supporting the banks on funding climate resiliency. Also, there is no penalizing the banks for not taking steps to protect their portfolio. So like exactly what Jim was sharing, like we're doing because we feel like it's right to do and we want to do it. I feel that a lot of other banks might not be in the same spot. Each bank treats it differently. So I think that's a huge challenge. And a second challenge would be everybody's running their own program and product. So we have single individual programs. They're not talking to each other. So we're here and we're, opportunity to develop partnerships and systems between government, nonprofits, and us bankers, addressing that as a group, as policy with capacity and financing. So we have to incorporate that ecosystem resiliency in our projects. And last but not least, I think that like CRA, the hospital systems have something called CNA, the Community Needs Assessment. So we need to partner more with anchor institutions like hospitals and universities into working on funding climate resiliency. So I think that that's an opportunity for us.
Thank you. Should we take some questions? Yes, ma'am.
Hi, good morning. Andrea McClellan, Norfolk City Council. I wanted to talk to you about PACE financing, property assessed clean energy. So it is available in the state of Virginia, and we passed in the last General Assembly legislation that in addition to clean energy and renewable energy efficiency, resilience can also be included for PACE financing for commercial properties in the state of Virginia. Nobody's used it. Are you all familiar with that? Are you interested in lending to commercial, nonprofit, institutional property owners for part of their capital stack, for stormwater, for resilience? Because as a locality, we can't do a lot of financing, but if we can at least get our property owners to start doing it themselves through this financing option, it would really help us as a municipality.
Thank you for sharing. I mean, that's a really interesting program. It is hard for banks to do something that's brand new. So we have a whole risk management and enterprise risk management group that, they're waiting to see who's going to go first. And especially banks like mine, I'm $17 billion. So it sounds like a lot of money, but that's a really, really small bank. So I'm waiting for other banks to come in and create some programs and really understand how that works so we can come in and see how we could best fit in it. But thank you for sharing. We do have interest in financing those projects. It's just how can we follow in the steps of somebody that can set up some precedent.
Thank you.
Yeah, and I'll run it. I mean, North Carolina, South Carolina, my day job market, so I'm not aware of it, but I'm jotting and I'll run it through our Virginia team. Yep.
And I think that's something you should run by Virginia Community Capital. So a lot of financial innovations, conversations going on with the CDFI space. And we actually have something coming up in San Francisco after the first of the year about CDFIs more in this space and what they can do to be innovative. So I would have a conversation with them.
And banks, we fund CDFIs. So a lot of my deposits and investments go to CDFIs, so that would be another vehicle to find funding.
Thank you. Other questions?
Jennifer Harada with Broward County. Appreciated the question that was just raised and really relevant to our area's needs as well. But kind of piggybacking on that, we've had the city of Miami Beach that has altered its seawall elevation requirements, and so there's going to be a lot of individual property owner investments. Seawalls can cost, when reconstructed, on the order of $50,000 to $100,000, depending on the length. City of Fort Lauderdale has adopted an ordinance, and we're in the process of adopting one countywide in our county. And so with that recognition, there is a lot in the way of private property owner investment that will be required as seawalls are collectively being elevated to a new standard. So as part of the 4-county collaborative, where we have nearly 6 million property owners, of course not all of them are right on the water, we did try to use the capacity of a forthcoming financial need to put a call out to the private sector financial parties and solicit proposals that might help create a funding source to aid individual property owners. And we received not a single response in the 4-county a request for or letter of interest, RLI. I don't know why. I don't know that anything was communicated in the way that what was presented, limitations, or just an entire disinterest. I'd be interested in knowing what your perspective might be given our circumstance.
So just top ahead, not knowing a lot, but so obviously this goes back to a lot of regulatory and policy world, right? Like loan to value type factors. And so the big question, I don't know, would be, are appraisal values changing when if a person puts a higher seawall, does it increase the value of their property? And has that connection been made so that, because obviously then we're gonna like lend, you know, when you think about the boxes in which our consumer lending is working, it's gonna say, you know, we'll lend up to 90% or 80% of value, but if the appraisals aren't coming in around it, you'll get an exception, and then the Fed will say you have too many exceptions in your consumer portfolio, you need to run those down, and then you just can kind of see where all this heads, right? So, so that would just a thought on your issue and a broader one is, as these changes are being made, are we recognizing that the value of the property with the change is different? And I'm not sure about that. That's just a thought top of the head.
Good question.
Yeah, and my advice would be to maybe bring a group of banks, Virginia Community Capital, some foundations, because a lot of foundations are starting to be more interested in structural change as well. Might add some incentives to the deal, but I'd bring them in, and instead of issuing the RFP, I'd have a conversation. So it goes back to that first point about it's relational.
Yep.
And I would start with a conversation as opposed to a.
She's Florida, so Atlanta Fed?
Oh, yeah, Atlanta Fed, yeah, sorry, Broward, I missed that,
Yep,
sorry.
no. Yeah, Atlanta Fed.
Atlanta Fed, but there's CDFIs, there's 900 plus CDFIs across the country. I'll think of the name of the one in your area in a minute.
I'm familiar with the CDFIs, but aren't the requirements also that you then have to issue 60% of the loans to low LMI community? And when you're looking at the investments of this
Right.
type, you're probably not going to hit that
Yep,
target.
Broward County on the water is not LMI.
Yeah,
Yes.
yeah. Right.
So that's a key point of CRA. You have to serve low to moderate income communities. The definition is 80% of the area median income and lower. So yes, I mean, a lot of the coastal region would fall out of the LMI, so we're thinking about the second and third lines.
Except when you're in the disaster, it can be
Disaster,
applied
yeah.
more broadly.
But that's reactive, yeah.
Yeah,
That's
yeah.
the problem, is like you're waiting
Yeah.
for a disaster to happen, and then you can be more
I'd still
reactive.
bring them to the table. I'd bring all of them to the table to talk about it. I'd include foundations. I'd include other institutions and have a conversation about it.
Other questions? Yes, sir.
There are two.
There's a gentleman right back there.
Yep.
Hi, my name is Ryan Franklin. I'm a 2L at William & Mary Law School. So recently, we know that Moody's required a majority stake in 427. They've also released reports that they're going to start taking more into account sea level rise and climate change in terms of credit ratings. So in terms of the banking industry, what is your perspective? Have there been any changes into how you evaluate risk following this report?
I rely on data from the credit risk, the ratings from agencies, and I rely on data that's being produced by regulators. So that's the
Yeah,
key.
so the big piece, and I think someone from Moody's is here, and really look forward to the conversation, and I think it's great that they are taking that into place. But realize that Moody's is putting ratings on for bond issuance, right? Not in direct bank lending generally. And so that's going to be larger publicly traded companies or corporates or municipalities for the most part. And so we definitely see it in our public finance business. We're already stressing, I was telling somebody, like we finance beach renourishment projects, right? So there's thought on, okay, so we're financing the sand to come back on to keep the tourism. For how long is the sand going to be there? And what's the term you should lend on that? And, where is the sand by the time the loan's actually paid off? And so there's a lot of thought definitely in what we're doing. And then in corporate, we have certain industry targets that we think have more environmental impact, and then we put second layer of look on them. We have a committee that it kicks to. We've actually sent teams out to talk with large corporates on their CSR strategies before we'll make our lending decision, to make sure that we believe that it aligns with what we want to associate and provide our capital to. So definitely steps, and I think that what Moody's is bringing to light definitely makes a lot of sense. But generally, the piece there is that a small business or a commercial company in anyone's town doesn't have a Moody's rating, right? They're coming to the bank, and the bank is then making a credit assessment. But similar, I think we're looking at it at those levels.
More? George?
So one of the things that we're trying to figure out in Boston is if we build these coastal barriers, obviously you're massively reducing risk for the property owners on the inside of the coastal barriers. But there's no obvious way to amortize that risk reduction in a way that actually pays for the coastal protection. Are there any innovative things that you have run across in your experience that allow you to do that? Is this a problem with adaptation as opposed to mitigation? Because usually with mitigation, there's some energy savings or some other thing, and you can amortize that. There are insurance schemes you can do with it, et cetera. But are there any actual operating examples where you've seen where people have amortized that risk reduction in a way to actually pay for the coastal protection?
I have not.
I think the answer is no.
No. I mean, you're right. I haven't thought about it in the light of like energy savings projects that we see in finance all the time, under this assumption that these energy savings will be found. And so, sort of way to structure it. I don't know. That'd be interesting. That'd be a good.
Resilience ESCO or energy performance contract.
Right.
Yeah.
It's a good question, George. It may be one of those things that we can look at as we're trying to pull this.
Can Moody's put a rating on it?
together.
Can we figure it out right now? Let's see. If you could put a rating on it, you could probably get bonds to the market. But I mean, the size, the scale you're talking about.
Yes, ma'am.
Thanks. It's kind of a follow-up to what John just asked. It's one of the things that we struggle with when we look at benefit cost analysis, particularly in our projects that we're partnering with the Corps of Engineers on. There's also no valuation for ecosystem services. And as we look to try to do more natural and nature-based features, we have a really difficult time providing our leadership, particularly in transportation, with the benefit cost analysis for that. Is that something that you also consider when you look to loan funding out, if they're incorporating natural features? How do you put a value on that investment?
I'll say like the commercial banker. So on our side, I mean, we wouldn't put a value on that, but we'll definitely consider it part of the equity. And then we can, make an investment, aka like make a donation for that, to support that equity. So it would be in a capital stack would be in a different column. Instead of the debt, would be on the equity side.
My boss over here tells me we've got 5 more minutes, so we can answer more questions, or we have more to say if you don't have any more questions.
It's a quick question. Disclosure. Nobody's brought this up, but from a financing standpoint, you all have a lot of weight in Washington and state capitals. And we in Norfolk, in the state of Virginia, there is no disclosure requirement for past flood claims. So I've got constituents who end up purchasing a house. They have one floodplain and they're in a severe repetitive loss category because they weren't aware of the 3 prior claims when they bought. I know NFIP is considering an amendment that would require FEMA disclosure. Can you, as from a finance, mortgage, banking side of the world, have you all talked about that? Is this something that, in terms of risk, it seems like as somebody who's financing, you would want your the folks to whom you're lending to know their risk. And at this point, in the state of Virginia, it's buyer beware, and we can't get that. So can you help, please?
Yeah, so the other side, sure, and this is the other big thing that's going on in Washington that has implication here that we haven't talked about is so during the crisis, essentially, we as taxpayers are backing a majority of every mortgage in America, right? So I don't know if everybody's aware of that, but essentially Freddie and Fannie have a government implied guarantee on them and are still not free and loose 12 years later. And just yesterday, they actually came out with the target to try to get them loose into a free market, standalone companies, and let them hold capital and start building up their structure by 2023 or 24 is the goal. So as much as the part of the issue in some of this, in mortgage especially, is that mortgage brokers and banks and others aren't holding the risk. The mortgages in America are put to these 2 organizations, generally a large majority, except for like jumbos and others, we do hold the risk, and we do look deeper there when it's on our portfolio. And so that's why, I mean, that's right, the Quicken, everything you do, the apps, they're packaged, sold to Freddie and Fannie, and they have a government implied guarantee on them for every mortgage in America. And we don't know what the stress test of those portfolios look like if in crisis, right? Like right now, it's kind of, they're hidden. They're not really reporting. Have you ever seen, I've never seen reporting on what they think their climate risk is.
Haven't seen that.
So that's the other big, the CRA change and that change, what they do when they go free market, they'll start being publicly traded again, kind of by, hopefully in 4 or 5 years. And then they'll go free market. And when that happens, how they react will be very interesting.
Jim, a related question, though, in terms of disclosure is how does the pressure that public and private companies are under to disclose publicly their resilience and climate risk, how does that affect how you look at them and underwrite what you do? Do you look at that?
We definitely, on the corporate side, we're very much so. In their disclosure, what industry, I mean, we've eliminated energy companies, we won't do single fire coal plants at all, we won't finance. I mean, right, there is something to the fact that you can stop a lot of things when you take money away from it.
Yeah.
So, and that's usually why the banks come into play, especially in some of these spaces that we've had to lean into. But the mortgage one is a tougher one, very much so, an individual mortgage, because again, like I said, we can make that decision and the person can go on their phone and get a mortgage
Somewhere else.
and that it's going to be sold to Freddie and Fannie, and it's just,
My timekeeper has said that it's time, so it's. Can I have another minute? One? Yes, ma'am.
Really quickly, I was just wondering if you could provide some guidance. You said we should have a banker at the table when doing planning, and since many of us are clearly not very clear on some of these banking pieces of information, I'm wondering if you can provide guidance on who in the banking hierarchy we should be reaching out to when we're doing planning.
Good question.
Well, so you would start with whatever banker you have a relationship with, is what I usually tell people. So if your organization has an account, whoever you deal with on the account, if it's your personal banker, start with them. I mean, the vision is the CRA banker is kind of the center of the hub and touches different parts of the bank, but start with who you have the relationship with.
Yeah, I'll hit it from my spot. I mean, so like a person in Talia's role, like I have a land trust, like a city council reach out with a land trust introduction they wanted. I have my community development banker sitting with me because I'm sometimes dangerous overhead. So so I would say getting community development CRA is a big piece. And then business and commercial bankers are dealing with companies and kind of, just usually good minds on figuring out risk, et cetera.
So all banks have to make their CRA disclosures public, so you can look on all of our websites and look for the CRA, and right underneath it, we have a contact information. It's usually like CRA administrator at the bank, so we get to the community development department if you don't know their names.
And you can always ask for a bank's CRA exam as well to look at what they're doing. You can ask for it at a branch. If they don't have it there, they'll make it available. And if you're into data, then go to ffiec.gov, and then you'll see the universe of CRA data.
And every bank is ranked every 3 years. We get through a full exam on our lending, investments, services we're providing, and your outstanding is the highest rating. That's what David alluded to. We've had outstanding since 1977 when it started. And then it goes satisfactory, satisfactory, and then
Gold
needs.
star.
Satisfactory and then needs.
Satisfactory, and then needs
Needs
improvement, and then substantial non-compliance.
Okay.
Yeah.
There you go.
Well,
The bottom.
But you can get the grades.
Yeah.
well, thank you all for your time and attention. Thank you, panelists, for a great discussion.
It's like the bottom of the barrel, like.
which is where the main breakfast was earlier today. We will be playing a video from Senator Mark Warner during lunch, and you'll also have an opportunity to hear from our VCPC students about the projects that they're working on this semester. So I do encourage you to get through the buffet lines quickly and return to your seats so we can get started. Thanks.